Hello and welcome. In this video, we will learn about hybrid mutual funds, index funds, and exchange traded funds. Alright? Now, I am in etmoney.com. I'll go to explore mutual funds and I'll click on hybrid funds. Now, we have learnt about equity funds, we have learnt about debt funds. Now it is time to learn about hybrid funds. Well, in reality, there is nothing much to learn here because the mutual funds that are in this category invest in both equity and in bonds. Okay? Equity funds are those which invest only in stocks and hence the risk and reward is high. Debt funds invest in bonds only and so the risk and reward are low or medium. And here the hybrid funds manage both the risk and reward by investing in both stocks and bonds. So here if you see, aggressive hybrid is a category where they invest maximum up to 75% in stocks. So the rest 25% would be in bonds. Okay. So for example, if you invest 100 rupees, then maximum of 75 rupees would go to stocks and 25 would go to bonds. Okay. Next, equity savings max up to 35% in debt securities. And we have conservative hybrid where they invest max up to 35% in stocks and rest would be in bonds. Okay. When comparing this and this is riskier than this because here they invest 75% in stocks. Alright? Yes, there are other classifications too, but they are not required right now. Okay? Now, let us learn about index funds. So, here in equity funds, we have large cap index, mid cap index, and small cap index funds. Before learning about index funds, let us learn little bit about index. You already know what an index is, correct? And you know how to check about indexes or indices on NSE. So I'll go to market data on nseindia.com and click on indices and you'll get a list of all the indices here. Okay. Now, when we say Nifty Auto, for example, Nifty Auto contains the automotive companies. But you must remember that apart from these companies, there are many other auto companies too. Alright. Now, when we say Nifty Auto, it doesn't contain every single automotive company out there. Okay. Apart from these, there are various other automotive companies too. But what are these? These are the best ones. These are the ones that satisfies the criteria to be selected to this index. Okay. Now, in future, if any of the company fails to satisfy the conditions of the index, then it would be removed and a new company would be replaced here. Okay. Or a new company would be put here. Alright. Similarly, if I go here, I'll click on Nifty Bank, the famous Bank Nifty, and if you see here, there are many banks here, and you must know that apart from these banks, there are various other banks too, but these are considered to be the best, and these are the banks which satisfies the criteria to be selected into this index. And if any day any of the bank fails to satisfy the criteria, it would be removed and the new different bank would be put in the index. Okay. Now, let me go to the index funds. See, if you want to invest in Nifty or if you want to buy Nifty, you have to buy either Nifty futures or options. Okay. Now, Nifty futures and options are risky, and the futures and options were made for hedging purpose. Okay, it is not made for investing purpose. If you want to invest in Nifty but do not want to trade in the futures or options, then what you can do is go for index funds. Okay, index funds. So let me click on large cap index here, large cap index, and all these mutual funds loads up. So here there is a mutual fund called as UTI Nifty 50 Index Fund. So I'll click on this. Basically what this fund does is it invests in all the companies that are in the Nifty 50 index. Okay, so here I am in Google and I have typed Nifty weightage, and I'll go to this website which is by ForbesIndia.com, and here I get a list of 50 companies that are in Nifty 50. Okay, so these 50 companies comprise Nifty 50 index, and their weightage is also given. Alright. So basically what this fund, Nifty 50 index fund, does is it tries to mirror the Nifty 50 index. Okay. Once again, this mutual fund tries to mirror the Nifty 50 index. What happens here is the money would be invested in the same stocks that comprises Nifty 50 index. So this is what Nifty 50 index has, and this is what this mutual fund has. If you see here, we have HDFC Bank, we have HDFC Bank. And what is the weightage? 13.26%. Here almost equal, 11.57. Next, we have Reliance 9.11, and here we have Reliance 10.16, and ICICI 7.42, ICICI 7.59. Alright. So what happens is the money that we put, the money that we invest in, or when we invest money in this mutual fund, they would be spread out on all these companies in these proportions. So basically it is like investing in Nifty itself. Okay, so the returns that you get by investing in this mutual fund would be almost equal to the returns of Nifty 50 index, and this is why these are called as index funds, because they try to mirror the index. Let me go back, let me go to mutual funds, and let me go to equity mutual funds, and let me go to mid cap index. Okay, mid cap index. So here we have HDFC Nifty mid cap 150 index fund. Okay, so this mutual fund tries to mirror Nifty mid cap 150 index. Okay, so the companies that are in Nifty mid cap 150 index would also be in this mutual fund and in the same proportion, almost same. All right. And whenever some stock is taken off the index, it would be taken from the mutual fund too. If a new company is added to the index, it would be added to the mutual fund too. For example, here is a news. Okay, so here it says Shriram Finance will replace UPL in Nifty 50 from March 28th. Today the date is March 7th of 2024, and as of now UPL is in Nifty 50 index. Okay, but due to some reasons UPL will be replaced by Shriram Finance, meaning UPL will be out of Nifty 50 index and Shriram Finance will come into the Nifty 50 index. So if there is any index fund that tries to mirror Nifty 50, then they would also remove UPL from their fund and add Shriram Finance. Okay, by doing that they mirror the returns of index. Okay, so I hope the concept of index fund is clear. Now ETFs and index funds are almost similar. ETFs are exchange traded funds. The difference between exchange traded funds and index funds is similar to that of the difference between stocks and mutual funds. Now, ETFs are similar to stocks. Index funds are anyhow mutual funds. Exchange traded funds, as the name says, are traded on the exchange. Index funds are not traded on any exchange. You have to buy index fund or invest in index fund and then redeem it after some time. Whereas you can trade the exchange traded funds. Okay. Now I am in Google and I have written list of ETF in India, and I'll go to the first result by nseindia.com. So I'll go to this and you can see I get a list of all the exchange traded funds in India right now. Okay. Now how many are there? 150 plus 37 plus 9. If you go to your broker, for example, you may be having Zerodha or Grow or Angel Broking, and if you search this, you will get this and you can buy this just like you buy a stock. The price of one fund here, one unit, is 56.26 rupees or almost this value. Okay. This is one more ETF whose one unit value is 47.54. Okay. Now, when you buy this, when you buy one unit of this exchange traded fund, you are not buying one share of a company or one unit of a company. But what you are buying is one unit of this mutual fund. So your money would be in all the companies in this index, not mutual fund, index. Okay, index. All right. So these exchange traded funds can be traded on exchange just like you trade stocks. Okay. So the prices of these ETFs would be varying from morning till evening. Whereas if you consider index, the NAV would be calculated at the end of the day. Okay, at the end of the day. All right. Yes. So there are many other differences between index funds and ETFs too, but let us not go there. Just remember that ETF is an index fund, but you can trade this on the exchange. Okay. Next, let me go back. The exchange traded funds. The index funds are passive funds. Okay, they are also called as passive funds, whereas the other mutual funds are called as active funds. The reason is here passive investing is done where in the index funds. Here active investing is done where in other mutual funds. Now what is active investing? What is passive investing? If I consider this large cap category and if I consider HDFC Top 100 fund, there are how many? There are 46 stocks in this mutual fund. Now what the fund manager of this mutual fund would be doing is regularly monitoring these 46 companies. He would see which company is performing good, which is not performing well, which company to be removed, which company should be added, how much shares of a company should be sold, how many shares of a company must be added, and so on. So the fund manager here will be actively managing this mutual fund. Okay, actively managing this mutual fund. Whereas if you come to the index funds, index funds just mirror the index, correct? So whatever companies are in a particular index, the same would be in this mutual fund too. So there is not much role of fund manager here. Okay, he doesn't have to keep on researching about the companies. He just have to have the same companies in the mutual fund that are there in the index. So that is why this is called as passive investing or passive funds. These are called as passive funds. Now what happens is the expense ratio of passive funds will be lesser than that of active funds, because in active funds the mutual fund manager would be active and cost is involved there for the fund manager, let us say. Here in passive fund management or passive funds or index funds, there is not much role of a mutual fund manager, and so the expense ratio would be less. Okay, yes, so that is about hybrid funds, index funds and exchange traded funds. All right.